In this presentation, we will continue on with part 5 of our example problem related to a not-for-profit hospital, this time constructing the statement of changes in net assets. The statement of changes in net assets is a bit different than what we would expect to see in a for-profit type of organization. It does measure timing, so it's going to be in conjunction with what we would think of as the income statement. So this is going to be a bit different type of a statement, so you may want to spend a little bit of time here. You'll recall last time we left off with the statement of operations, which is very similar to the income statement. Everything about the statement of operations went pretty straightforward because we felt that we were going to take these temporary numbers down here, these revenue and expense numbers, these timing type of numbers, these numbers that measure performance over time. We're going to take the revenue as we have up top. That looks pretty straightforward. And then we would take the expenses as we did here, and then we would subtract the two as we would expect on an income statement and get to the net income here called the excess of revenue over expenses. However, you'll recall that this excess of revenue over expenses is going to be from normal type of operations. Then we have the non-operating gains and losses where we included the investment income without restrictions. So this item, so now these two added together, that still seems pretty normal, kind of like an income statement, no problem here. That gives us the excess of revenue and gains over expenses. Excess of revenue and gains over expenses. That seems kind of like our bottom line number. That sounds a lot like net income. Excess of revenue and gains over expenses. However, it doesn't match what we had down here, what we would expect to get to if we were to add up all of these temporary accounts. The difference being this 681, which is the unrealized loss on investments. So that seems like our net income number, but it's still not quite there because it doesn't take into account that 681, and we're going to have to deal with that somehow in order for our double entry accounting system to be in balance. Not only that, but we don't stop there in the statement of operations. Then we're going to just move on, and we're going to go to the net assets released from restrictions, which is going to be in essence this number. We unrestricted the assets to get the 97.5. If we add the 91.340 and that number, we get to the 188,840, that being the increase in net assets without donor restrictions. So again, bottom line is this number is basically closest to what we would think of as our net income number. We're adding this number to the amount that was released from restriction to get to another kind of a number that could be useful for us, but it's called the increase in net assets without donor restrictions. So that's going to be our two. Now we're going to do basically a reconciling item. Our next statement, which is going to be the statement of changes in net assets, and we can kind of reconcile the difference here to basically include this number, which we're going to have to do, and we'll see that this number, the number that we would expect to see, is kind of like the bottom line number of an income statement type of account as we do so. We do this so in a little bit backwards type of fashion, so let's go through this. We've got the net assets without donor restrictions. That's going to be the 91,340. That 91,340 is going to be this number here. So that 91,340. Then we're going to take that and we're going to include the unrealized loss on investment as expected. So if we took that then, if you were to net these two out, you'd say, okay, well that makes sense because now we're going to take the 91,340 minus the 681, and that's going to get to our 90,659. But we don't quite stop there. We're going to take that, and then we're going to take the net assets released from restriction, which of course is this number, the 97,500, and that will give us then the increase in net assets without restrictions. So the increase in net assets without restrictions then, the 188,159. Next, we're going to say the net assets with donor restrictions are going to include net assets released from restriction. So notice that these two basically cancel each other out now, right? We added that, now we're subtracting it just as we do here. And then if we take that 188,159, the increase in net assets without donor restrictions, and we subtract back out the 97,500, we get to the 90,659, which is finally the number that we would expect to see on basically the income statement, given the fact that if we just added up debits minus the credits or credits minus the debits of all of these temporary accounts, that's the number that we would get to, which we're now calling the increase in net assets, which makes sense because that's going to be our not-for-profit kind of term for basically net income, because net income is the change in the net asset account. So remember, the net assets, you can think about like the retained earnings for a corporation. The change in retained earnings is typically going to be the net income. Although with a corporation, then we have dividends and possibly, investments and stuff like that. Dividends that could be involved, throws it off. We don't have any dividends here. That's why we don't call the corporation net income. We don't call it change in retained earnings, because there could be other things in there. In a sole proprietor, we might call it, you could say it's the change in the capital account, because the major change in the capital account is net income. However, there could be something like investments or draws in there, which again throws it off. We don't have that here. Therefore, we can simply call the net income type number as increase in net assets. Then we're going to get to the net assets at the beginning of the year. So in essence, this is our bottom line number, the activity, the performance over time. Then we're going to get back to what we would be like the equity type of numbers by then adding the net assets at the beginning of the year, which will be the blue accounts. So the net assets at the beginning of the year being 2087260 plus the 250860 plus the 176240, that being the 2,514,360. So if we add the change and the beginning balance, we then get to the ending balance, the 2,605,19. This number then will tie out to our balance sheet. So that number will tie out to the balance sheet. So then if we have everything we have so far, this is our bottom line number we just got to, that should tie out to the balance sheet here. So if we were to consider what we have so far, we'd say, okay, is all this working? Well, we can see that the assets equal the liabilities plus the equity. We can see that the excess of revenue and gains over expenses is going to tie out to the excess of revenue and gains over expenses here. And we can see that the bottom line number on the net assets at the end of the year is going to be tying out to the net assets section of the balance sheet. So those are some of the checks that you can go through as you start to put together or analyze financial statements.